What's up, team? Sean Vesta live here, and this is actually a specific video I'm making because one of the recurring themes I've been getting on Twitter and in the YouTube comments is for a little bit more detail on some of the specifics around how I hedge and what kind of moves I make and how it looks as it pertains to certain positions. So that's what I'm going to do today. I'm going to answer the questions. I'm going to keep it very basic, very easy to understand, and I also want to caution sort of around a few key areas that I think are good to be aware of and when it makes sense to not do these things. Okay. So let's jump in as always, not waste any time. So, first and foremost, the idea of hedging. Hedging is a really simple concept. The idea is, as I rub my eye here, the concept here is that you're trying to protect yourself from a directional move against you in the market. Okay. It can be a move up, it could be a move down. A lot of times, actually, frankly, it could also be side to side moves as well. So you can generate some sort of play there. In the case of what we're going to keep it on for today, this is really like a 101 level understanding of how to leverage puts against open long positions. So even more basic than that, you own shares and you want to protect yourself if the price goes down. That's the easiest way to think about this. And that's the approach that I think most people, I would say probably 99% of people who watch this are probably coming at it from. So that's number one. The other thing I want to get into is you don't have to hedge. Okay. You don't have to do these things. In fact, most people neither have the account size nor the account balance or the amount of shares really necessary to do a lot of hedging. However, there are some positions that have a higher degree of risk than others. And I think it's just important to at least understand there are some things you could do. Now, full stop, before I jump in, I want to say this. A hedge should not be based on YOLO trading. It should not be FOMO stuff. It should not be a way to protect yourself from a bad call based on a lack of research. Okay, so the idea here on using a put as a hedge is that fundamentally you own shares of something you believe in. Okay, maybe it's an index, maybe it's a specific stock in a specific company, but fundamentally you have conviction and you believe long term the position you're holding is a position you want to hold in your portfolio, but you're recognizing the fact that things could change, or there might be pain in the market, or there's some sort of event happening like earnings or inflation reports or CPI or whatever that could impact you short term, and you just want to see if there's a way to capitalize on that or create some protection in case it fundamentally changes something in the market. Okay, so it's important to understand that there's long term protection, there's short-term protection, but also if you don't have a massive account, spending the money to buy options to protect yourself can really eat into your profits. So you should think about whether or not you're at an account size where you aren't better off just using stops and taking a small loss and then jumping back in when the time is right or when the wash sales go away. So I'm only sharing this because not enough people who do this truly, in my opinion, actually understand how these things work because they don't really do them and they haven't done them for a long time. So I just want to be really clear that hedging is great and it has saved my rear end countless times and actually made me a very serious amount of money. But it also comes with understanding that if you have a $5,000 account or much less even, does it really make sense to be paying out premiums to protect yourself, or is it just smarter to get out of a position and then get back in when it makes sense? I can't make that decision for you. That's a you decision. So let's jump into it. So let's just say, for example, we are playing the indexes. So maybe it's QQQ, maybe it's SPY, maybe it's VTI, whatever. Okay. Long term, you know that these things are going to go up. But you also recognize that we could have a recession either here or incoming. There could be bad earnings reports. Inflation's out of control like it is today at the recording of this video. So I think it's very particularly interesting to think about how do I protect the downside on the position if it's going to go down for a long period of time and have an opportunity potentially to turn a profit while also protecting myself. Well, enter buying puts. Okay. A put is a contract that you are buying the rights to, but not the obligation to act on. And what it's saying is that I'm going to make this so simple, it's impossible to misinterpret. A put is basically you saying, I want to buy insurance against my shares so that I will make money if the market goes down. Now, you have to pay a premium to access an option. It could be dollars. It could be hundreds of dollars. It could be thousands of dollars. You can buy one contract. You can buy 10. You can buy 1,000,000. You can buy any number you want. Okay. And there's also how long the contracts are. They can be, a couple of days. It could be a couple of weeks. It could be a couple of months. It could be a couple of years, right? So you've got a couple of decisions to make in terms of thinking about a put, right? The timeline. You also want to decide at what price you want to buy it at. I'm going to get into that in a second to tell you how I do it. It is not a recommendation. It's just how I do it personally. Okay. And then the other piece of it to consider is, of course, like I said, the cost for them to make sure you're actually getting the benefit, because there will be a break-even point, right? If you pay $500 for something, you have to make at least $500 of profit to actually, you have to earn $500 on that position before you start to make profit on it. So that's why I'm saying you need to really look at this in the terms of the way we're talking about it, not as a way to make money, but as a way to protect your portfolio first, okay? Based on conviction in the holdings that you have. There are lots of people who can talk about speculating and trading options and all those things. That's a whole other topic that's not related to hedging, okay? So in this case, what we're going to do is we're going to look at a major index, for example, like QQQ, and we know that's been beaten down. We think, hey, you know what? This thing might go down even further. And let's just assume you've got a sizable position, right? So it's a big enough position that it represents a large part of your portfolio. You really don't want to be in a position where you're just taking losses long-term on it. And you want to make sure you have some degree of protection, especially, I'm going to call this out, even though I typically talk about it, although I do not recommend most people trade on margin, okay? A lot of folks do trade on margin. The benefit of options with margin is it actually decreases your margin risk. This is a super complex topic, but I'm going to make it really simple. If you have $100,000 worth of margin and you use $50,000 of margin, you've used half of your margin. Fair enough. If those prices go down, you're eating into that margin and you're going to find yourself in trouble over time of a margin call. You can reduce the risk of using that margin, and you can actually get access to more margin by matching puts up against equities that you're buying in margin, okay? I don't think you should be doing this, but I want to call it out for those who are. If you're in a situation that you don't know how to get out of, or you're panicking, I'm not saying this should be your first option, but there are ways to leverage puts within a margin portfolio to create more breadth of access to margin or more breathing room in it while things are down today, okay? Just want to call that out. So here's the basic concept. I've got my QQQ shares. Say I've got 1,000 shares of it. Let's assume the trading, I'm just going to use rough numbers. $300 a share, you've got 1,000 shares, you're talking $300,000, right? This thing goes down 10%, you're down 30 grand, right? It goes down 20%, you're down 60 grand. That's real money. So what I will do in situations like this is I will go and decide two things. How long do I think the pain is going to last for? How long do I think there's risk in the market? And then what are my pricing options on puts that I can buy for those positions? So right now, what the way that I've approached this is going back 6 months ago, a year ago, depending on different positions in my portfolio. I started looking at the market. Things were getting very frothy. Prices were getting very, very high. And what I started to do was marry up puts. I want you to really focus on the word marry here, right? Marry means for life, it's long term. So what I was doing was I was looking at the largest positions in my portfolio and I was marrying puts to them, long term puts. Oftentimes we'll call these leaps, right? Length enhanced options, essentially. And what I did is I just bought them at the current strike price of where that stock was, or that ETF or that index was right at that time. So call it 300 for the sake of conversation. And I just sit back and I let that downside protection act as a hedge on any losses I might take in the equities in the meantime. And I just leave it there. That's why we call it marrying, right? You're marrying the position to each other. And you can decide based on the cost, based on your feel of risk and on your conviction of downside, how many contracts do you want to open? Do you want to literally try to do a 1-for-1, which is going to be a lot of money, but potentially you need to? Or do you want to just have a couple because you're going to hold the position for a long time, but you maybe want to make some money on the way down? You can decide what size contracts you want to lever up against your key position there. Now, additionally, let's just say, for example, we think there's going to be massive downside because of a near-term event, right? The Fed's releasing minutes. There's an earnings report coming up. There's something significant happening from an economic perspective. Well, we can also look at it and just take short-term puts. Maybe it's for a week or two or a month or 2 months or something like that. And for me personally, again, I'm not recommending it for your portfolio, but for me, even in short-term situations, I still will keep my strike price at the current price. So at the money is what we call it. There's all kinds of reasons and all kinds of ways to do this differently, but to keep it as 101 level as possible, I like to think about in terms of the timeline, at the money pricing for a strike. The strike is the price at which the option, um, you know, takes place at to execute on. And then I also look at the timing. So here's where there gets to be some variance in the way to think about this. I'm of course talking about an index fund, which we know historically over time do typically always go up, right? There's a number of reasons and factors for this. Um, that's a whole nother video. But what about when we're talking about stocks, right? What about very volatile stocks? Nothing will really change here except for the fact that you have to think very aggressively in terms of your timelines and your strike prices. Although I still don't change much for myself, it's really important to understand that there are some positions that are just inherently much more risky. Think tech stocks. Tech stocks are really a great example of where I leverage puts at scale. Um, excuse me. So, unlike an index fund, a smaller sort of mid-market sized or smaller cap tech company can absolutely skyrocket. We all know this. We've all seen it. But they also can go to the floor very quickly. So I want to give you a couple examples here of things that I sort of felt and saw out there in ways that I took action on it. So I had released a video a while back about a company called Upstart. I was very negative on this company. I still remain very negative on this company, but that's not my point wasn't necessarily about the stock price. It was about the business. And if you watch this channel, you know that that's my approach to all things is I'm concerned about the underlying company and my conviction in their business model and execution, not necessarily about their price. The price is how you take action on your conviction. Your conviction's built on the company, your action's built on the price. So that was a case where I felt it was extremely overvalued. The stock had come down considerably. And I was basically suggesting to folks, if you have large positions here, you should start to research how to leverage hedging. Now, that stock ended up continuing to get pummeled and dropped from 100 down to the 20s, down to the teens. Now, if you held on to that stock, you are now down from all-time highs of around $400 to like the teens and 20s and maybe at some point the 30s. You're down in a huge way. If you held onto those shares without doing anything, you would now be out all that money. And you hear things, people say, well, I'm going to dollar cost average back into it. I'm going to urge folks who are not aware that trying to dollar cost average into positions that are down 90% would require an astronomical sum of money to ever get back to break even. And even then, it may not get back to break even. Now, the converse is if you didn't get out when things started going down for whatever reason, of course, those decisions are your own. One way you could have played a position like this is a classic example of leveraging puts. At that $100 mark where I felt exacting negative conviction in this position. Now, I didn't own it, so that's why I didn't sell a put. But for those who did own it, this is a perfect example where you could have gone and sold puts. And as that price continued to crash down, the value of that put contract would have continued going way up. And it would be worth a lot of money because options are inherently levered positions because each contract represents 100 shares per contract. So although you may still be in a position where you would have potentially taken losses depending on the size of your holdings, it would have created at least a way to balance out the risk to some degree. So your losses may not have been that bad, or potentially, depending on the movement of the options, you could have even made as much or more money than you would have lost on that position. Now, one caveat I want to call out too, and this is where it gets a little bit into the YOLO, which I don't want this to be. If you're looking at a position that you think has the position to go down to those, small dollar amounts, you can choose a strike price all the way down there at a 30 or 25 or 20, whatever the dollar amount you're looking for. And you'll pay practically nothing for those puts. And as the price comes down and they start to become more and more valuable, that's where you really see those massive gains and options that people often talk about. But again, this is where you're speculating, and I don't want that to be the purpose of this video. So I'm going to sum this up really quickly because I realize I went longer than I meant to. When I think about my strategy for how I hedge, There are a million different ways I might do it. There are a million different ways that I can think about doing it. But the most basic, easiest way, if you have no experience in this space and you want to learn, because that's the only thing you should be doing after seeing this, is digging in deeper. What you can do is you can either marry puts long-term against your positions. So you would buy a put, or if it's for short-term movements, you can look at near-term close contracts that are going to be, in and around those reports, those earnings, those news events that are coming out, and play it for the short term. But I really, really want to double down on this because I think it's easy to get the stuff lost in the weeds. If you have a position that you don't have conviction in, hedging it is not going to ultimately protect you, because that speaks to a process error in the way that you go about running your portfolio. There should not be, for beginners, if you are a relatively new investor, a beginning investor, less than a couple of years, you're a beginner. Even if you're great and you're doing amazing earnings, you're still a beginner. And there's nothing wrong with that. It's just a stage of going through this. You should not be holding positions that you have no conviction on or you don't believe in the first place. Why would you want to hold something with your real money that could lose you money? To me, that makes no sense. So if you have high conviction but near-term concerns, this is one of the ways you can consider hedging those positions. Feel free to hit the comments. I'll do my best to answer the questions that I can that come in. What I would say is, if you made it this far in the video, I would love if you wrote the word hedge down in the comments, just so I can see who got this far. And I think there's different strategies here we can go on or off of from here, but I just want to share like a basic, elementary level 101. If I was starting tomorrow and I had big positions that I was concerned about, this is the way that I would typically protect those positions. I want to make one more statement here and I'll close out. If you have positions in your portfolio that you do not have conviction on, hedging them is not going to protect a bad decision, okay? You're hedging it as best you can. But if you have positions you don't believe in and you think could go to zero or a 90% loss or a 50% loss for that matter. Now, granted, we're in a recessionary period. Crazy stuff is happening in the market. This may not be applicable at all times. But if I have positions in my portfolio that I've lost faith in or my conviction is now not strong, I exit those positions. And if I'm wrong, I'll jump back in. And if I'm right and the price resets and now I like it again, I'll jump back in. But there's no service being done to your personal wealth by holding on to terrible decisions just to watch them lose money in the hope that someday through magic they get back to where they were. You can't spend 5 years and tens of thousands of dollars to break even. That's insane. That's a terrible way to look at it. Talk to your CPA or your tax preparation expert. They can explain how you can write things off, but make sure you're taking advantage of what you can to protect yourself, your portfolio, and your personal wealth. So with that, thanks so much, everybody, for watching. If there's anything not clear here, please let me know. I do really know this space well, and I try not to go too deep on it. But it's a really interesting dynamic place to start learning and researching on how to protect your high conviction holdings. So again, thanks everybody. Have a good day. Have a good weekend, and we'll see you. Bye.